Here to react to the Powell presser and the Fed's rate cut are Euro-Pacific Asset Management Chief Economist and Market Strategist Peter Schiff and NatAlliance Securities Global Fixed Income Head Andy Brenner. Welcome to you both. Great to have you here. Peter, I'm going to start with you, my friend, because you don't believe the Fed should be cutting rates. Why is that?
Well, first of all, I think the Fed stopped hiking rates prematurely, so that was a mistake, and cutting them now is an even bigger mistake. Look, inflation is too high. It's at least 50% above the Fed's target and headed up. That calls for higher rates. Gold at $4,000 is screaming that the Fed is too loose and it needs to hike rates. Back when Alan Greenspan was Fed chair, he said he used gold as a barometer of whether or not he had the right interest rate. And he said if gold was at 400, it meant he was too loose. So what does 4,000 mean? Plus, I think it's an even bigger mistake that they're prematurely ending quantitative tightening. The balance sheet is still $6.7 trillion. If you recall, Ben Bernanke told the U.S. Congress that we were not monetizing debt because he said that the increase in the Fed's balance sheet was temporary and that all the bonds that the Fed was buying during the crisis would be sold back into the market when the crisis ended. Well, at the end of QE3, the balance sheet was $4 trillion. We're a lot bigger than that now, and that proves that Ben Bernanke was lying to the U.S. Congress. We are monetizing debt, and that's why we have such a big inflation problem that's going to get worse by these rate cuts.
Let's get our other guest in here. Andy, I want your reaction to these words that turn the market on its head, but also Powell talking about, as he was saying, ending quantitative tightening during his press conference on December 1st. Listen to this.
The balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Andy, does it give markets time to adapt? Is this the right move? What do you make of it?
Well, first of all, I think this was very much a hawkish Fed rate cut today, I think on three levels. First, you had the fact that Powell reemphasized that December is not a done deal. That sent the odds for December from 95% this morning to 68% when I last looked at it a minute ago. Secondly, you have to look at the fact that Schmidt did dissent, and that tells you that you can expect the same come January from the likes of Hammock, Logan, and possibly Kashkari. So that's the second thing where it looks to me like December, if they do cut, will probably be the last cut in a while. And as far as to your point, as far as what the Fed's going to do with the end of QT, they're going to take whatever they have in mortgages, and as they mature or as they get called in, they're going to put that into Treasury bills. So that's going to take a lot of duration off the table. So I think it's very negative, which is why you're seeing a very strong bear flattening today with the 2-year, based on your last thing, back 11 basis points, and the 10-year back 8. So I think it's going to be hard times for the next few days. It's
a big move in the market. Andy, last meeting, the newest Fed member, Stephen Moran, was the sole dissenter because he wanted a larger cut. What do you make of the dissenters this time around? Because we have dissenters on both sides of the table.
I think it's more key. I mean, look, Myron is clearly a Trump appointee in doing what Trump has asked him to do. So if the Fed were to cut 50 today, he'd still dissent. So that doesn't really matter. But Schmidt, on the other hand, is a pretty moderate guy. We've heard him speak numerous times. And the fact that he went out of his way to dissent at this point, when the labor situation still looks very weak in our opinion, tells me that it opens the door for the next round of Fed appointees from the banks that start in January. So I think it really opens the door for December, if they do get a cut, as being the last cut for quite a while.
Gold, Peter, right now, you mentioned it before, trading about 4,000. How high do you see gold going? What are we going to see in gold prices going forward?
Well, gold's going a lot higher because the value of the dollar is going a lot lower. I mean, the Fed has made it clear that it doesn't care about inflation, that the 2% target no longer exists. The Fed is easing into rising inflation. And I think the bond market is figuring this out. That's probably the most problematic reaction today. Look at the big increase in long-term interest rates following this rate cut. And in fact, I think this is going to continue. And I think the yield on a 10-year out to the 30-year are going to be quite a bit higher when the FOMC meets again in December. And I think the bond market is basically saying, we don't believe, the rate cuts. We don't believe that inflation is headed back down to 2%. And so we don't want to buy these long-term bonds. And then this is part of the de-dollarization trade that is continuing to push more and more money into gold. And I think later in the year and next year, you're going to start to see significant and broad-based U.S. dollar weakness against other fiat currencies, and even more weakness in the bond market, which is going to bring the Fed back to quantitative easing. I think ending QT is just the first step towards relaunching quantitative easing. And I think that's what the markets are also sensing, which is why the price of gold is going much, much higher.
Peter Schiff and Andy Brenner, thank you so much for your expert commentary today. Really appreciate it.